Hey everyone, I'm Cary Smith and I'm sitting here with Amar Shah. We're both with Client First Capital. And Amar, today we're talking about a topic that I think is probably on everybody's mind, especially if you're an investor or saving for retirement. And that is the volatility that's been happening in the market these past few days or weeks. And so, without any further ado, let's just jump into our topic.
Yeah. So February 20th was kind of like the peak of the market. And then we've had this increase in volatility, specifically with the VIX going up to 30. But I want to bring up a couple slides before we get into the meat of it. So this slide here talks about crisis and events since 1970. And the reason I like this slide is I just want to show that we've been dealing with market. If you're invested, you have to deal with market volatility, right? This is not a straight line up. There's bumps up and down all the way throughout, and that's just part of being an investor. The next slide here, what we're looking at, and is inter-year declines versus calendar year returns, right? So markets don't go straight up, it goes up and down. Within a year, you can have large declines like we're seeing now of 8 to 10%, which we see here in 23 and 24. But you still end the year positive, and both 23 was up 24%, 24 was up 23%, and you have north of 20% returns when you've had intra-year drawdowns of 8 to 10%,
So
right?
even though 23 and 24 are two most recent years, I think hardly anyone remembers the 10% and 8% declines. They just remember those were two really good years in the market.
Yeah.
And I have a comment on your previous slide, if you could jump back to that real quick. And if I was just trying to read some of those events, and
Yeah.
a lot of those events, I'd say most of them are international events, which means they're not things that we have direct control over. They're things that are going to be happening in our world that our markets are going to react to. And I think it just underscores the point of it's important to be nimble and always watching the market and adjusting. But most of these things, I would say maybe all of them are totally out of our control, and even many of them out of our country's control.
Yeah. 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 I think that's good perspective to have in this. I think the last slide here that I want to share is that what we're looking at is the up run in the blue in terms of bull markets, and then we're looking at the yellow or the golden color as when we enter bear markets, right? Or orange, I guess that could be. Uh, and then behind that, we're showing the economic recession periods, right? So this is a big piece that I want to cover in terms of the markets or the economy doesn't mean the market, right? And what everybody's looking at right now is that the markets are gone down. Are we in an economic recession? That's the first question. Or is this the start of a bear market, right? And I think those two pieces are really what's drawing investors' minds. People that are in retirement, looking at their retirement accounts, they're trying to say, should I shift into T bills because I don't have time? And this looks like we're going to be entering a recession. So I'm going to give probably about 2 or 3 minutes worth of commentary on our views at Client First Capital. And then, Cary, we can kind of wrap it up with that, with some questions potentially that you may have. But really, what we're in is a normal market cycle. Included in this normal market cycle are some things that are not normally, uh, are events that increase volatility, and the timing just happens to be all together, right? So first thing is we're going into quarterly options expiration, and that increases volatility just with dealers that want to be market neutral. There's a lot of buying and selling that happens, which naturally increases volatility. So next week, Thursday, Friday, is the end of options expiration for the quarter, and we're heading into that. So volatility naturally increases. Number two, we have tariffs. The new administration is trying to get a grasp on the economy and make their mark on terms of the economy as well as the markets. And the tariffs have been on, off again, and the markets are trying to react because it's hard to drive a business, run a business, especially like manufacturing, when you don't know what you're paying for parts and what you're going to export those parts are. So manufacturing companies are stockpiling parts. Tariffs are on and off, and there's a lot of like confusion, if you will, in terms of the markets. And then the third thing I would say is that we also have the federal government to see what's happening there in terms of jobs, in terms of still being funded, right? And so these three components have added a layer of uncertainty on top of uncertainty, right? And that has exacerbated volatility. And volatility, in a normal market cycle, as we've seen in the last slide, 10 to 14% is normal, right? And we're not even there yet, right? I think this is just in the short term. So to answer the big question, are we headed to recession? I mean, I don't have a crystal ball, but our data shows at the moment we are not headed directly into a recession, but this is more of operationally how markets work around OPEX, right? Now, let's say June, July, August, nobody knows what's going to happen there, right? But for right now, we are doing our analysis around what's happening in the current environment. With that, will the economy, will the markets bounce back? I mean, when options expiration happens, the money has to be reinvested. Money has to go back into the markets. And so there is a higher probability that after options expiration, that dollars will flow back into the markets, meaning that there's more buying than selling, pushing markets back up, right? And I think that's kind of the position that we're looking at, and that's what we're taking. You know, for individual investors, you have to look at your financial plan, how everything fits in. But the key here is to have enough liquidity to outrun some of the volatility, right?
Okay,
Cary?
so Mar, so I have a question for you, and I'm a not only work for Client First Capital, but I'm also a client, right? And
Right.
so with all this volatility, it hasn't really kept me up at night because I trust the process and I feel that everything is being managed properly, and I'm not too concerned about it. But I have a lot of friends that are do it yourself investors, and what I find is they tend to be a little emotional about politics. And so if their administration is in, they're pretty confident about how the economy is going to perform. If the person who's leading is not their administration, they're a little more nervous, and they're letting those political biases impact their investment decisions. And I find that it often has them on the wrong side of the market by making those kinds of decisions. And so I guess where I'm leading with this question is, could you say a little bit about your process, right? That removes the emotion out of it and just stays focused on the data and the markets.
Yeah, we're a very data-driven company, right? And so data plays a big part. Look, the markets, if you invest, you want to invest so that you can make money. Nobody's investing so they can lose money, right? And there are investors that are Republican and there are investors that are Democrat. And so the market, I would say, is this one neutral environment where everybody wants to make money, right? So with that context, having a process is the number one thing you can have to remove your personal emotions out of the investment process, right? And so our process is fairly simple. It starts high level, understanding and contextualizing the economic environment. That's step one. Step two is really back testing what assets have done well in this type of environment. And step 2.5 is, are those investments doing well today, right? Just making sure that things have done well in the past. Well, that doesn't necessarily mean they're doing well right now. So we want to verify that piece. Step 3 is really looking at the market structure. The economy is one piece, but the market structure is different. And the economy does not equal the market, and the market doesn't equal the economy. We saw that on that one slide. Here, we're trying to figure out with dealer positioning, what are the flows within the market, and kind of finding that structure From there, we decide to make sizing decisions of, all right, we should buy X, Y, and Z. How much should we buy? When should we sell? And making those type of decisions. But in that whole process, it's all math based, right? We're looking at numbers and we're letting the process drive decisions. Even me, as somebody that's managing all these funds, I have emotions too, right? And having a process is the number one thing to get my own emotions out of the investment decision making process. So I would say, to answer your question, the number one thing that investors can do is to have a process and then follow that process.
Yeah, very good. Okay, I don't have any additional questions. I think you did a good job of bringing this process forward, talking about the volatility, the importance of having a process. So I'll just see if there's anything else you want to add before we close.
No, if you have questions about your own investments and you want to have a second set of eyes look at it, please reach out to us. Our website is down below. You can please like and subscribe this video. It helps other people find our content. And we have a newsletter that comes out monthly. If you want to hear directly from us, you can subscribe to that on our website as well. Thank you, Cary.
All right, thanks, Amar.
Bye.
See you.